5, 4, 3, 2, 1.
Hello and welcome to the EUVC Lowdown, the show wrapping up the week in European venture. I'm your host, Cathy White. Let's jump into the headlines this week. London-based Ocean 14 Capital announced that following an injection of fresh funding from Inga Group, it has now raised 130 million euros of its target 150 million euro fund. The Ocean Sustainability Fund will back 20 to 25 growth stage ocean restorative businesses over the next 3 years. According to the OECD, by 2030, the blue economy, that's the ocean, will generate $3 trillion in value through new businesses. Startup Wise Guys announced the first close of a 45 million euro fund with 25 million euros in the bank to invest and expand around Europe, Africa, and Latin America, building on last year's rollout in 2 southern European locations, Italy and Spain. At least 200 startups should benefit from the new funds as part of its accelerator programs. The European Investment Bank Group and the governments of 5 EU countries have announced a new 3.75 billion euro fund of funds to invest in VCs that back European scale-ups. The group is targeting a 10 billion euro fund of funds. That's 10 billion euros. That's quite a lot of money to retain European growth talent, with Spain, Belgium, Italy, Germany, and France all committed. This is part of a bid to kind of outbid the US and China. Change Ventures announced their semi-annual Baltic Startup Funding Report this week. The Tallinn-based funds report showed that while the number of investments has slowed in line with the global slowdown, the number of growth and Series A funding rounds was still well above pre-2021 levels, showing the potential health of the ecosystem longer term. And data from Dealroom has shown that Lithuania is leading the CEE pack, with the Lithuanian startups valued 4 times more than the average for the whole region. The UK government has turned its attention to the skies, announcing a £6.5 million fund to back 18 space tech projects as part of a renewed growth funding initiative. And finally, change is happening at London-based Hoxton Ventures. Founding partner Rob Niaz is leaving to start a new firm focused on deep tech and tech bio. He'll lead deals through Hoxton Ventures from the third fund and will continue to work from their London office whilst building his future fund. Joining the team is Peyton Dobbs, currently a UK general manager at Google and an advisor to Hoxton since August last year. If you have news you'd love to highlight on the Lowdown, you can find me, Cathy White, on LinkedIn or on Twitter at CathyWhite10. Joining us on today's show, we have a couple of our regulars. We've got Dann Bowyer here, partner of SuperSeed, and David from the EUVC team. And fellas, I've got a couple of different stories for us this week from the world of venture capital that I thought we could sink our teeth into. The first one has actually come from Ryan Brown, a journalist over at CNBC. He reported on Thursday that we could see a rise of zombie VCs. The Walking Dead, could emerge over the next few years, with firms that are unable to make an impressive return for their institutional backers, focusing on managing the existing portfolio before eventually winding down. I've got a few different quotes that I've pulled out from the article. The first one comes from Maëlle Gavet, she's Techstar's CEO. We expect there's going to be an increasing number of zombie VCs that are still existing because they need to manage the investment they did from their previous fund, but are incapable of raising their next fund. That number could be as high as up to 50% of VCs in the next few years that are just not going to be able to raise their next fund. Now, at no point in this article, just as an FYI, does this 50% claim get cemented with anything. So it feels maybe a little bit like finger in the wind to me.
Don't you love clickbait though, Cathy? Don't you just love a little bit of salacious Daily Star clickbait nonsense?
It's so good. Like, we do need it in our lives. But yeah, I mean, 50% sounds very, very, very high. But, you know, tell me what are your thoughts on this, on the rise of the zombie VC?
I think it's easy when, I think there are two main threads kind of running through our veins at the moment in the startup ecosystem, across the startup ecosystem. One is this kind of constant drumbeat of doom and gloom, which I blame Google for, because if Google hadn't screwed publishers wouldn't need to be so salacious. Now, that's one thread. The other thread is that there is, underlying the nonsense, 50% I think is bullshit, underlying the nonsense, there is a real reset. There is a genuine reset. I don't appreciate salacious headlines, and I don't appreciate a lot of the stuff There's a classic one that you and I argue about a lot, Cathy, the whole 1% for female founders piece.
Yeah.
So that as an example gets wheeled out a lot. There are a whole bunch of stats that either the tech press or particular individuals who want clicks will wheel out without context and without sharing a full story, and in this case without data. So it's not like anyone has looked back to the .com or the GFC and worked out how, I know going backwards doesn't necessarily give us all of the insight, but it will give us, history rhymes or whatever that cheesy phrase is. But I think there is definitely a reset happening. There are definitely going to be LPs and GPs caught in the breeze. I don't believe it's a binary, oh my God, 50% are dead. That's just not how the world works. And you see a lot of disrupted and affected venture capital firms that have now gone back into public markets or have created new vehicles to come downstream or created very specialist niche vehicles. So it's not like, everyone is just going to sit on their hands, either not invest or they're totally screwed. There will be a very, very slim percentage who are overexposed to the nonsense, grow at all cost, 10-second grocery deliver e-scooter nonsense. There will be a selection of those, and there'll be anyone who's doing all of the who was doing growth and started in 20 was probably totally fucked. But it's not the 50%. It's not going to dictate the future of venture capital. If anything, the noise, the energy, and the driving forces that were there pre-nonsense are still fundamental to our market. Startup are still, the whole space is still the source, the only true source of innovation. It's the only true source of getting new things to market. It's the only true way of making change. So that's not going to change. The amount of government support. Now, this is an interesting thing. Obviously, I think 50% of European funds have some form of government backing it, and someone correct me if I'm wrong there.
Back that number, 50 what?
It's these 50 percentage points that keep getting thrown around.
I think, there we go. There's another salacious clickbait.
I'm kidding. There is data out there.
I think I'm right.
Already.
Is it higher, David? It might be.
No, it's hard to estimate, but yeah, 50% of the money in Europe comes from a public source of sorts, right? So it might come through the big ones or the national funds or whatever.
So what governments are saying, and this I think is and the returns have been very, very healthy. And I think this is an incredibly powerful strategy. And in the grand scheme of things, when you look at GDP, the amount pledged is minuscule. It's 0.000. It's nothing. Anyway, if governments really want the kind of returns that America is seeing across Europe, they need to do it. And if we really want the true innovation and the change, you have to fuel the ecosystem. So I think it's a very, very smart strategy. However, will that slow and stop? Because political forces are much stronger than commercial and reality sources. So what I fear is that there's going to be a perception that the government shouldn't back these naughty venture capitalists or this awful VC thing, and that I think would be a shame. But there's a whole world of inertia, isn't it? $200 billion worth of inertia baked into the system. So that I think is a challenge. And then my last point before I shut up, sorry, I'm waffling, is the challenge will be not in 2 or 3 years time, but in 5 years time when we get into recycling.
Yeah.
So there's going to be whatever is impacting now, and no one really knows the weight of this. But when founders aren't exiting and recycling, when LPs aren't seeing returns in recycling, when GPs aren't performing and therefore creating the returns in recycling, there's going to be, but that isn't today, tomorrow. This is another folding back to the original zombie piece. This isn't a now, today. This is going to take some time to wash through, and it will just wash through naturally as this reset occurs. There'll be a more heated, natural wash through. So in short, I don't buy the number. I think it's a salacious bullshit comment, but there is a great reset happening, which will shape the trees. And so bloody shit.
Yeah, no, I like you're referring to it as the great reset or the washing. And in the way I like to think of it is getting rid of the fluff, like shaking out a carpet.
And also getting rid of the unscrupulous. There are a lot of bad actors. Every industry has bad actors. I mean, venture has a particularly bad name because we sit in ivory towers and we flick peanuts at poor people, right? And so we should be poked in the eye. But every industry has bad actors.
Yeah, they do. Just on 2 things you said, Dan, so that you're talking about the government tie-in in Europe. It's just worth mentioning that this week, EU members clinched an agreement to raise a €10 billion fund of funds.
It's the right thing to do. If anything, We should be putting more into smaller businesses. They are the net creators of jobs, the net creators of employment, whereas big business, mid-caps aren't. They're the net destroyers of opportunities and the net destroyers of jobs. So if anything, through difficult times, we should be fueling through every vehicle possible, startup, small business, mom and pop, changing, anything that's fueling that bedrock I think is supremely powerful, and we should do more of, especially in downturns.
Yeah, I kind of want to read you some of the other quotes from this article now, because I'm liking the fiery response that's coming on.
Let's do it.
Well, it just makes me laugh, right? So Miles obviously made this 50% claim. You know, it is salacious. You're right. There is some truth to it. But, you know, other things that came out, you know, Steve Saracino, I'm probably mispronouncing that, I apologize, Steve, from Activent Capital said, we're going to see a lot more zombie venture capital firms this year.
There will be firms that are fully deployed and can't raise. I mean, that happens all the time. I mean, if you look at the results, it's only the top, I hate these phrases, but the top quartile that actually perform to an LP's satisfaction. So 75% of the market doesn't really perform. Now, or is average to bad results for LPs. It doesn't mean that LPs aren't going to take those punts, because when it does work, it's outsized returns. And if you look over the last 10 years, VC has been one of the, if not the highest performing asset class in the world. Now, yeah, there's going to be, like this year, there's going to look what will optically look like zombie VCs, where they're post deployments, they're in their harvest. They can't now raise a fund, but that doesn't mean that they're dead. That doesn't mean they don't come up with a new strategy next year or the year after. It's almost a meaningless thing to say we're going to get zombies this year. What is a zombie? What are you defining as a zombie? Somebody that has just finished deployment and hasn't raised within the remaining 9 months? Who gives a fuck? Can they raise again, or should the company change? It's a bit like founders don't die, startups die, but founders don't. They go on and move on. So you think these VCs are going to just drop the mic? Oh, that's it. They're not. I mean, some of them will. So maybe some of the unscrupulous ones that were in pure growth and just backing e-scooters and 3-minute grocery deliveries and whatever else. You know, trying to get the never greater fool money in. That's finished for now. For now, but you know, the smart people in venture aren't going anywhere. They'll create new vehicles, and so what's the zombie?
Yeah. I think that's a great point. And I was thinking here, we know, and I'm bringing it back home, back like focusing on Europe, of course. But as Dan was saying, we know that Europe performed right in venture. We have the data. C8 data shows it. It actually outperforms the US, right? So we know it's a great space to be in as an investor. But we also know we had this hype fest of tourist money coming into the industry. That's no news, right? And tourist money comes and goes, and as the public markets shift from one side to the other, well, guess where the fucking tourist money is going, right? It's going back to where it used to be, and that's expected.
The tourist cash was like 70% of growth. It was a lot. It wasn't 10%. It was the majority of growth.
Yeah, exactly. And that's expected, right? So it's like, yeah, sure, that's nice. And I don't want to get ahead of ourselves and talk about the next topic, but we also know of LPs backing out and saying, well, I actually am overexposed to private markets and I want to readjust my own portfolio. So there's also that, right? And I didn't see that even referred to in the article. I didn't read it in detail. I didn't even see that referred to.
It was a little bit.
Nah, but not the dimension, like as Dan was saying, the dimension of it. It's not like a tiny thing that's happening on the sideline. No, it's fucking huge, right? It's the growth was driven by it, right? It's the second that trend shifts, the whole like that will impact. But my question or my comment, maybe, and I'd love to hear Dan's thoughts about it, right, is I agree with what the fuck does zombie mean, right? But the way I see it, the most important thing in venture, right, it's not about timing the market. It's typically timing the exit. It's timing the liquidation moment, right? And so a zombie VC is managing a portfolio. So managing a portfolio means, well, ideally, I guess, I assume that's what they're saying, right? Investment period is done. I assume that's what they're saying. I'm not sure. But that means the investment period is like, it's the focus, right, of that portfolio. So the question is, can a zombie VC deliver returns, yes or no? Well, in theory, yes. In practical terms, I actually don't know, but I'd love to hear Dan's reflection, because you might as well say, well, let's double down on delivering the promise that we did. Let's wait with our fundraise a bit, because the market's shit. We know we have enough fees. We don't need to get fat on fees. That's fine, right? And we raise when the markets recover a bit, right? Is that a zombie VC? No, that's a fucking smart VC, right? Dan, I don't know. What do you think about that?
I think the one key challenge that I see for later stage, so let's say you're mid-tier and growth, you are a pure financial investor and you have fully deployed, so your deployment period is over and you're now in support harvest. There's not that much you can do if your portfolio is new, raw, and to you that is, and is caught in downturn. What can you do? I mean, in the States, more VCs are ex-operators than financially. Across Europe, it's a tiny percentage. But even so, regardless of your history and your skill within the organization, what actually can you do to support those businesses? The only thing you can do at those junctions is enable the business to survive, and that's maybe some support, consulting, connection, network, and then help them raise the next round. Now that's the bit. Now but it goes back to the original point. If you're fully exposed to 2021's prices, you're fucked. But who is? No one is. I mean, unless you're a pure tourist.
On that note, like what we're seeing ourselves in our portfolio, and our portfolio is small, right? But it's already big enough to see some stuff. Is we're seeing, and I'm not saying our portfolio is distressed, they're actually not. But what we're seeing is a focus on helping the startups is on operational efficiency, of course, right? As everyone's saying in the market, that's no big news. But it's also about working with those founders and preparing them how to think about the next round and the different scenarios, right? And what are the blind spots? And this is early stage bias, right? Super early stage bias, because that's what I have exposure to.
Then you have the potential chops, but they're not the people. I was speaking with one of our founding teams yesterday, and part of their challenge is that a big part of their ICP is scaling startups. So post A, so they're not scaling, they're in growth mode now. And they're raising their Series A. Now a lot of their Series A investors say, I don't like your ICP. I don't like you serving recently closed startups, which I think is bullshit, because if you know they've got £2 million in the bank, you know they've got 2 or 3 years of buying your service before they're going to warrant it. It's a little bit, it's a bit like anything. We have to sometimes make excuses. We don't find something compelling. We have to find the weakest part of the pitch to then pick on. But I don't think that's a problem. I think there's if you're for the earlier teams, if you're a VC in the early, you haven't been massively affected, and yes, quantums have shifted upstream, so the C to A has probably gone from the 1 million ARR to the 2 million ARR if you're in SaaS. So everything has been, but I think that'll be short-lived. I don't think that'll be a long request. I think that will shift this year, I would think, as people start to loosen their wallets and start to get back into the game. But I don't think if you are in the later stage, there's not much you can do.
That's true.
Your company think of operational efficiency as a very short conversation. Cut your burn, lose 20% of your workforce.
Yeah.
That's a very short consultative period.
But so this is me kind of regurgitating what I hear and what I listen and what I read, because I have no experience whatsoever there. But as an example, I was listening to the All In podcast the other day, right? Super US centric, but much more experienced investors than I am, and I'm saying like Series A, Series B founders not being able to read their own balance sheet or their own financial statements, right? So that got me thinking like, is this a US thing? Is this a hype round thing? I don't know, right? But it also got me thinking. But my point being a very different one. I think there's one on the article, right? Coming back to the article, 50% of what? AUM or number of firms, and that's a very different conversation, right? Extremely different conversation. And then the second point I want to make is like the reason why I push it back to Europe in early stage, because that's my agenda, right? I believe in early stage and I believe in Europe. And if you put out something like this, I think the negative impacts of it as a media, right? The negative impacts of it tend to affect more the early stage, right?
Oh yeah.
Which is actually a disservice to the industry in my own view, right? Because I don't think it's true for most early stage investors, and I might be wrong, but that's kind of where I'm coming from.
But you have to look at it in sectors though, David. You can't. I mean, if you look at some of the consumer stuff, it's going to struggle. The B2B stuff isn't. I mean, we've never been healthier. We've never done more deals. We've never seen more deal flow. Obviously, we're lucky. We did our first close this time last year, so we still have 3 years of cash in the bank to deploy on the strategy. So
dry powder.
We just closed an incredible. One of our founding teams closed an incredibly healthy Series A yesterday with a very well-known UK VC. News to be published, I think, maybe today or Monday. So, and there was no discounting, and I'm using inverted commas and not on an audio podcast, but there was no discounting. So, but then, like I was saying a bit before, that the other founding team that is mid Series A raise, they've had loads of shitty kickback from the market. But I think if you're compelling, you're in the right space, So you can't be doing, I think some of the consumery stuff, but if you're in the right space. And I think that's part of this great reset, which I think is magic, because it means that we're going to now refocus on, hopefully, things that matter more to society and that are going to really move the needle and really create efficiencies and productivities and really change the way in things that we need and do. They don't have to be business. They could be, Airbnb was a classic. It was a wonderful personal thing that came out of the GFC, or was accelerated because of the GFC. And they couldn't raise for toffee. I mean, they had more no's than any startup in history, I think. So, I don't know what I'm saying here. But yeah, I don't think that the headlines necessarily match the reality by a super long stretch.
Yeah, my headline is bye hype investing, hello fundamentals investing. That's how I would write that article.
Yes, that's an article that people would really like to read.
So I would change it. I would change it to fuck off hype investing. Welcome back, fundamentals investing.
Okay, there we go. Yeah, it's adding those swear words in the headline that really make a difference for readership.
Not those fancy words.
Yes, sure, colourful words. There we go. I'm going to take us into the next topic, guys. I mean, David, you sort of were alluding to this earlier, but this week, Andreas over at the EUVC team shared some wise words, I guess from Gil Dibner over at Angular Ventures, about a huge explosion that is incoming. So we're going back to these salacious headlines, guys. Not moving away from them. Now, I'll try and skim through this to explain really quickly what Gil is getting to here. First of all, a lot of VCs have gotten really big, and I mean really big. We've heard of one case where a Fund 2 was raised that was 10 times the amount of all the capital deployed by Fund 1. Funds are doubling or more in size from one vintage to the next, and it's becoming pretty common. Second, VCs have been deploying capital very fast. And I think when we're talking about deploying capital very fast, we mean pre-June 2022, last year, maybe. So we've obviously seen the slowdown, but pre then it was all going a little bit crazy. That means they've been coming back to LPs for capital more frequently than those LPs modeled. LPs are not happy with this at all. Third, but even worse, the fast pace, of deployment has meant little D&D, higher prices, low ownerships relative to fund sizes, and often overlooked very bad time diversification. There are many funds out there that have deployed the entire fund at peak valuations. Fourth, a lot of funds are either fully baked at stupidly high entry valuations and deal parameters, or half baked at those stupidly high entry valuations and deal parameters. The fully baked ones are well and truly, and I'm taking this from Andreas's LinkedIn post, fracked. The half-baked ones now have a new problem. What to do now? Hold reserves for the messed up ones, or make new investments that are much smaller or more rationally priced. Bad performance is already baked in. It's not an easy choice, but it gets worse. And I think this is all part of the big explosion that Gil is talking about. Fifth, we are hearing from LPs that a lot of funds jacked up fees and carry well above the standard 2% and 20% that ruled the industry for decades. This means that net DPIs are going to be even worse than they would have been had the funds not been greedy. Now, I have next on my notes on my screen to turn to David, because David said on WhatsApp yesterday that he wanted to talk about naughty.
Yes.
That's a whole different off-topic topic, isn't it?
Can you expand on naughty and connect it back to everything that I've just shared from Gil?
Naughty. No, but I'm actually very curious to hear your thoughts on this one, Cathy, because I spend all day thinking about LP-GP relations. And even though Dan doesn't communicate that all day, I'm sure he thinks about it very often himself. So I'd love to hear your thoughts as well. But the reason why I brought up the term naughty, and I don't want to deep dive into it completely, because I think we should talk a bit about what's on topic, is because our industry is about trust, right? And it's about trust between the LPs and GPs to some extent, where, well, if I'm an LP, I'm getting pitched a strategy and I trust that the team will deploy it accordingly, right? And I trust that they will be stewards of my money. And that trust, you can write a bunch of documents and shit, but the trust needs to be there, right? And the same goes for the VC founder relationship. And I won't talk about that because Dan is better prepared. I think a lot of these examples show that there was some naughty behavior as part of this tourists, as I was describing before, this tourist kind of movement of everyone wants to be a VC now. So everyone's raising a VC fund. And now I'm talking about early stages. How many operators did we see wanting to raise a fund, or former heads of product or heads of engineering or whatever, just because it was cool? And like behind closed doors, the conversations between LPs, because obviously we meet with many LPs who have much more experience about us, is the common question to these guys was, well, is this their next thing? Like, and are they just kind of having fun with it, or is this actually what they want to do with their life, right? And I think so many things in the Gil Dibnar articles, thread of Twitter posts just shows that this is naughty behavior. This is not like really what the industry is about. So that's why I wanted to bring up naughty, and I'll leave it at that, and we can deep dive into it.
So going back to Gil's original post via Andres, to Gil Andres post, the big explosion that's coming. I welcome thoughts here because, right? I'm sorry, but both things that I'm talking about today seem to be kind of doom and gloomy, zombies and explosions. But
let's get Brad Pitt in. It makes for a good movie. It's not all doom and gloom. I don't believe there's an explosion. But this is I don't want to repeat myself, but I don't know Gil, but if Andreas says he's a very smart, cool man, I trust him. But I don't believe there is any kind of explosion. I cannot buy it. I cannot. There is not one thing that you reeled off that I can't disagree with. I think again we're missing context, we're missing data, and we're missing timeline. Mm-hmm. So I don't believe that a lot of these things are going to happen. Excusing bad actors, or putting bad actors to one side for a minute, because there are always going to be in any industry people that do unsavory things. Just that's life.
Yeah.
And especially when there was so much easy, again, air quotes on an audio podcast, easy money to be made. Of course, you're going to get, look at crypto and all the nonsense. You're going to get this evil human greed extra bit layered in. Fundamental businesses and smart venture capitalists are there for a reason, and they're not going anywhere, and they're not doing unscrupulous things, and they're not jacking up fees, and they're just not behaving in this way. I semi-challenge David's trust driving force, of course, as part of the almost the hygiene. I'm not trying to dismiss it. There has to be a massive amount of trust between GPs and LPs, but LPs are very well diversified. They are not just they're not just looking at one GP to make all their returns and they're going to sit back on their laurels and game over. So of course trust plays into it, but they want to make money. They want to some of them want to change the world, but most of it is their mandate is preservation of wealth. I don't mind you being the wild card, which is maybe not just preservation of wealth, and this does definitely lean into your trust point. But I think this whole driving force here is baked in making, how am I going to get a return? And it's that brutal. And sometimes I guess I'm saying this, Dave, because maybe sometimes I can imagine, I don't know if this is true, some LPs maybe looking at, not quite sure I trust you, but I think you're going to kill it. This might go horribly wrong, or it's going to go incredibly well. But I don't think trust is maybe the driving forcing word there. I think it's maybe, I'm not quite sure, you're a bit of a tip, but I think you might actually make this one fly. So
I trust you're in it to make money, right? To generate wealth, right?
Maybe it's semantics. Maybe I'm trying to pick something apart that isn't there. I'm trying to understand. LPs are well diversified. Yes, they need to trust GPs. I don't believe that GPs are on the whole going to behave how you mentioned, Cathy. It's just not. And therefore there is no explosion around that, because it's a bit like saying all accountants one day are just going to not file your tax return. So of course they are. That's what they do for a living. They're gonna do their fucking jobs. Yeah, you might fight. Yeah, there might be a fee structure argument, but they're gonna do their jobs.
Now I was just gonna say there's one of Gil Dibnar's points about the second one he raised, I believe, or something like that, about capital being called very quickly, blah blah. I have seen that, so I have spoken with investors in funds where that has happened. However, the profile of those LPs is not the one that is well diversified, and that's exactly why I brought up the topic of trust then, because I do agree with you. LPs are they know what the fuck they're doing. They're not putting all their money in one GP and hoping to become rich, right? That's not the game. But when you talk about high net worths, angels, super angels, they do sometimes have their bets concentrated in terms of both startup investing but also fund investing. And what I have seen, and I don't see the whole market, so I'm obviously biased here as well, is where this thing of calling too much capital or much more capital has been in these more kind of emerging first-time funds that were very aggressive to market, like invest super quick, blah 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 blah.
We can't do it. It's part of our LPO. We can't do it. I don't think. It's a massive drag. I don't understand why you would do that. Forget making your numbers look bad. It's just.
It also happens if your target fund is 40 million, you raise 20, you close at 20, and then you're stuck at 30. what do you do, right? And this is like super hard for any GP. What do? Do you shift your strategy? Do you keep the strategy, but deploy percentual wise, right? More of your fund up front. And the stories I know are of exactly this case, right? And typically these are first time, second time funds.
That's got nothing to do with capital calls. I don't see the correlation. And if LPs are sending money without reading their own documentation or without asking what, and that's
it just really had to be a part of FTX.
But it speaks to the profile of that capital then, right?
Yeah, and also I can only talk about what I know. I mean, I just don't live in that world. I sometimes, I mean, this again, almost going back to female founders and underrepresented and other difficult conversations within our industry is like, and people say how other VCs behave. I'm like, that just doesn't compute. I just can't see. It's not that I'm unempathetic. I'd like to think that I'm an empathetic guy. You can't behave like that. You can't think. That just doesn't make any logical sense to me. So I kind of get lost when things kind of step outside of.
Yeah, absolutely. You're absolutely right, then. So if I speak of what we see in detail, so that the GPs in which we have stakes, everything that Gil describes, we haven't seen at all, like nothing. So we haven't seen baked or partially baked things. We haven't seen excessive capital calls. We've actually seen one or two of our funds. They said, we're gonna invest at a good pace, but not as high as predicted. So we're actually doing the capital calls 1 quarter later. So I'm actually seeing the reverse, right? If I run the numbers, it will actually kind of have a small average. So I'm not seeing it. I've heard stories, I've heard conversations, but I'm not seeing it either. So I completely agree with you that I don't live in that reality, at least. So I don't think an explosion is coming for those who've kept true to the fundamentals.
But I don't think an explosion is happening to impact the industry in a meaningful way. I think that's the line. I think it's a worthy debate and it's worth exploring and understanding. But I don't think any form of 50% of this or explosion of that is fundamentally going to shift meaningful behavior in our industry. I think we're looking at edge cases, and I think it's a really interesting thing to understand who and how much and when and impact. I think this debate is an important one, but I'm not trying to just be a naive optimist here. I just cannot see the fundamentals of our industry being shaken like this. It didn't happen before, and I cannot see it happening now. And there's not like, not only are the fundamentals strong, but there's so much money and inertia baked in. And it's in the hands of the people that we're talking about. So
I'm curious now with you're nice guys, aren't you? You don't see any of this crap that's going on. But I think it would be worth talking to the folks over at Landscape, for instance, and they would be talking purely about the VC and the founder relationship, nothing to do with the LPs, but some of the stuff that they get told through the anonymous community about stuff that happens.
It's not a lot of it. I mean, I've read a lot of and I think it's great to kind of glass door and open up what's happening in venture, but a lot of the commentary, when you really read, there are some people who have said some silly things or things have been taken out of context, and there are again some bad actors, but they're so few and far between. It's I don't buy some of the stories. I think some relationships go wrong, and sometimes founders are incredibly hurt when you tell them they have an ugly baby.
Never tell someone they have an ugly baby.
Listen, when my son was born, I looked in the pride and I went, "Ooh, that's that." That is. I've got Winston Churchill on dipped in seawater.
Dan's saying all of this, but before we hit record, he was talking about having a cuddle with his little boy on the sofa last night.
Oh yeah, I love them. No, I do. I mean, and to me, they're the most beautiful things in the world. But sometimes you have to tell a founder, and it is their baby. You have to, and often you have to tell them. Sometimes you can't do this. You have to tell them. Most of the time, it's them that's a problem, not the product or the offering as much as it is them. You don't buy them, and you don't believe them. You don't believe they can build a team. You don't believe they can sell, and that's I try and have quite candid conversations about that, but that's an extremely hard thing to do. You're the problem, sunshine.
It's the reverse of it's not you, it's me.
Yeah, there you go.
It's definitely you. Okay. On that note, guys, I'm going to wrap up for this week's episode. As part of this conversation, there is anything that you want to let us know, listeners of the podcast, please do get in touch. Check out the EUVC newsletter over on EU.VC and follow us, the European VC, on LinkedIn, where we can continue the conversation. And if you want to get involved in the podcast, we are eager, as always, to add more voices. So please do get in touch. And until next week, have a good one.